What do you think of as the most important lessons from the 2008 financial crisis?
Well, I think what it taught us ultimately is that interventionism, monetary interventionism, is a Faustian bargain. It gives us really short-term gains, and with that comes longer-term pains. I think we saw that previous to the last crisis, and I think we're sort of going through the same process now. I think what we end up having is a market that is just very good at sort of sandbagging us. It makes us feel for a long time like we're smart, like we all have an edge, which of course is impossible. We can't all have an edge. And then once we've upped our bets, it's kind of shows us its real properties.
Universally, your firm, and you by extension, wouldn't have a business if there were no financial crises. But as a matter of principle, or corrections, crashes, market meltdowns, an inevitable, necessary maybe feature of the modern financial system?
Certainly of the modern financial system, because of the way it's structured, particularly the way it's structured in terms of, again, monetary interventionism. Interest rates are not free floating. So it doesn't have to be that way. It's more of a philosophical disagreement between natural free markets. Are they sort of inherently fragile and need us to protect ourselves from them? And so it doesn't need to be that way, but unfortunately it is that way.
Some people say crashes, maybe not necessarily as big as the one that we had in 2008, perhaps more along the lines of what we had in 2000 or what we've had since, some of the stuff that was brought on by sovereign debt bubbles and such in Europe, are going to become more frequent. Do you think we'll see crashes more frequently?
I don't have a good feel for the frequency, the timing. It's something that I've always made very sure to stay away from, and the nature of my investing affords me that. I think we're going to continue to see deeper and deeper ones, and simply by virtue of the fact that the degree of interventionism is larger and larger. It gets incrementally higher every cycle. I mean, in some ways, we're still recovering sort of from that great bubble in 2000. And so the economy needs more and more in order to keep us afloat from that.
Tell me about the next crisis. What do you think it looks like?
The way I structure sort of risk mitigation, which is what I do, certainly, it means that I don't have the luxury of knowing what the next one's going to look like, thinking that I know what the next one is going to look like. I don't claim to have known what the 2008 looked like, even though we traded the way we did. It's really, for me, investing the way I do, insurance type of investing the way I do, is really about covering all your contingencies. You can't just isolate one contingency. You need to be able to cover many of them.
What I had in mind was more along the lines of this. People look back at 2008 and say, it was a once in 7 decades event. We haven't seen anything like that since 1929 and the Great Depression. And it'll be another 70 years before we have another crisis like that. And I'm just trying to find out whether you think there's any validity to that kind of thinking. If you can't predict crashes, can anybody else?
Yeah, there's validity to that. In many ways, I agree with it, but at the same time, everyone knows you can't fight the Fed. And you mustn't fight the Fed. What you must try to do is sort of jujitsu the Fed. You need to sort of use the Fed's force.
So the Fed is going to do what the Fed is going to do. In other words, and you as an investor have to respond?
Well, you need to be able to go with it in all directions, and that's really the point here. There's a great cliche that says offense wins games and defense wins championships. I mean, I hold that very close. It's a cliche that happens to be very, very true in the realm of investing, and that's because, of course, in compound returns, the rate of compounding is all we care about in investing, and it's the severe losses that crush the rate of compounding. It's not the small losses. So I really need to focus on, the reason why I focus on the severe losses, the crashes. So what does that mean? I call this a volatility tax, where large losses crush your rate of compounding. So we need to think about that. The von Clausewitz's first principle is secure your base, and This is what we all try to do in portfolio management, is to secure our base. But it's not what we do get through modern portfolio theory.